Aspen, which has been an aggressive acquisition trail this year, reported a 21% rise in full-year revenue to 788 cents. Now, the acquisitions have broadened its offering from medicines in fast-growing regions such as Latin America and Southeast Asia. Aspen Chief Executive Stephen Sard joins us now for some insights on their plans going forward. Stephen, thank you so much for joining us. Positive numbers all round. I would ask you where exactly are your key highlights, but it looks like it's almost everywhere.
With one of those sets of results, you always have something to talk about, something that went wrong, but touch wood, this was a set of results. We looked at it, every region performed, so it was great. I mean, the worst performing region grew at 20%, so that was great. I mean, it was South Africa, but we had regions like Asia growing at 77% and Latin America in the 50s, so a very, very strong performance.
Steve, not many chief executives can say that their worst performing sector grew by 20%, but I noticed that your operations from offshore grew by 63%. That's a huge contributor to any company's numbers.
It's we were exclusively a South African company not very long ago, so it is a very big portion of our sales that now and profitability that comes from offshore. And with the further acquisitions that we're looking at, it's going to be an even smaller percentage. But we're very proud of the fact that we manufacture so much in South Africa, and one of the few countries that actually process products in here, bring in primary imports, add value and export them. And it's been a fantastic manufacturing success story for a South African environment.
We'll get back to the production facilities in South Africa in just a moment, but I want to touch on some of the deals that you're currently in talks with. GSK in particular, there's also the Merck deal with the US, but there's also an interesting one that was revealed in your numbers today, and that's the MSD deal worth about $600 million, and that has to do with molecular drugs. Delve a little into that.
Yes, it is. So there's a link between the MSD or Merck deal and the GSK deal. There are some synergies between them, but I'll talk just quickly about both of them. GSK, we're buying 2 products from them globally. They do about $500 million, and we get a facility in France, and we get about 450 reps across the globe. What we really like about that representation is, as a result of these products and the products that we're buying from Merck, we're able to have about 30 more countries will open offices, Aspen offices. So we've been opening aggressively across Asia, but this will give us a very good presence across Europe, and particularly across Russia and Central Europe. The Merck deal is products, chemical products as well, and there's some very interesting chemicals. There's some biologicals, there's extractions from the mucosa of the stomach linings of pigs. That's the mucus from the stomach linings. There's
stomach linings of what?
Of pigs.
Oh my.
All the anti-clotting drugs come from that prevention of clotting, like deep vein thrombosis. That's where they come from. It's a heparin derivative. It's that manufacturing technology that goes into the GSK product. So that is the link between Merck and GSK. So some very interesting products, the harvesting of pregnant women's urine to create pregnancy tablets.
Stephen.
We're right up the biological chain in terms of where we're heading technologically as a company, and it's a very, very exciting transactions for us.
Let's also touch
as gruesome
on Russia.
as they sound.
As gruesome as they sound. Good, thank goodness I'm not pregnant, but nonetheless, let's touch on your movements in Russia. I'm sure you're hoping to hopefully see some kind of transformation once you take that under your wing.
Yes, Russia's a very exciting area. We as Aspen where we've positioned ourselves, as people know, they've got absolute stamp of authority. There's no 2 facilities. There's FDA quality products coming out of South Africa, and we keep them affordable. And it works best in emerging markets and growing healthcare markets. Now, the Western European markets are stagnant and declining. Russia is very similar to emerging markets, and our products and our quality, we hope, will be well accepted in the same way that we're accepted in Asia, Latin America, and even Australia.
But when one thinks of Russia, Stephen, it sounds as though it's a difficult regulatory environment to work in. How has that been, or what kind of challenges or obstacles might be in your way?
It's a very tricky environment, as is Latin America, as is Asia, but it's a very tricky environment, Russia. One of the advantages we see in pharmaceuticals have a very underdeveloped manufacturing sector there, and the result is that you have some poor quality products in that market. We're hoping, through having the turnover and the representatives that understand that market, to be able to add an organic pipeline of Aspen products behind. And that's been our success really in all our acquisitions. If we just acquire pharmaceuticals, we run out of money very quickly. But it's the growth that we've added to the acquisitions that we've made. When we bought Sigma in Australia, it did $70 million. It's now doing over $150 million. Those are all things that we add, the synergies we add. And we're hoping between Merck, GSK deals, there's synergy between themselves, but we can add to both as well.
But Stephen, as we take a look at your international operations, you've got your hands almost in every pie internationally. Would you be looking to list overseas?
No.
How come?
We're a South African company. We listed in South Africa. If you want to buy shares in the South African business or offshore business, you can buy, the JSE trades freely. Many instances we've had 80% of our shareholders offshore, sometimes 80% locally. Really don't want to create additional bureaucracy for ourselves.
Your thoughts on your competitor CFR as well as Adcock, which recently settled their deal?
Is the deal settled?
Well, according to the latest news that's come out, we try to stay on top of things.
Yeah, good. No, look, I'm not close to it, and good luck to them if they've done it, and good. If anyone who does well in our space, it's great. If it works, I'm just not close enough to the action on the other side.
Stephen, well, let's come back a little bit closer to home now. In particular, you're looking at capex expenditure in South Africa, in particular in Port Elizabeth. Were you hoping to increase production facilities there? So I take it that will obviously also help with job creation in South Africa as well as increase production levels.
Correct. There's capabilities we bring, and they are high-paying jobs. So it's a very there's a lot of opportunity that we can bring at the manufacturer. We've had to acquire the Firestone premises next door, but it's given us a lot of opportunity, and there's capabilities we can extend in sterols and oncolytics, that's sort of cancer products as well. So there's quite a lot of capability that we're adding to our South African site.
How soon or how quickly could we see new products being launched into the market?
We've got existing products from existing facilities. We've got a lot of products coming out of our facilities now anyway. So the Australian deal, a lot of those products are now already manufactured going to Australia, and there's quite a long pipeline of products that we continue to put into the Australian market from our South African facilities. It's an ongoing process, and it's a bit like a hosepipe. It's not going to stop for a while.
Stephen, also taking a look at your dividend, you've kept that fairly stable, no major increases, even though your earnings have been pumped up as though you've been drinking yeast.
Yeah, I think the way one should view these this dividend is it's really a confidence. It's an expression of confidence in our cash flow capabilities. Bearing in mind we're going to the market we should have total debt of nearly $3.4 billion. It's easier to say it in dollars than say it by rands. It sounds too big, but it's a sign of confidence that we're that confident in our cash flows and unwinding of cash flows that we are happy not to waive a dividend, and we haven't issued any shares in order to do these deals. Just
to close off with, Stephen, what could we expect for the year to come?
I think for the year to come, you can expect some very big growth out of Aspen, particularly in the second half, because our year is June to June. These deals really become effective from 1 January. So I think from H2 of next year, you should expect some fairly large growth. And for calendar year 2014, so it's January to December, you should see some very big turnovers coming out of Latin America, and hopefully we're doing something in Japan as well, in Asia, and we've got our 30 local operating companies set up. So yeah, all action at the moment.